Now we are going to look at the different accounting principles that we have studied in accounting, and they are those principles that are being used widely and they are being practiced in the accounting. And these are basically the set of the rules that or the principle that basically define certain rules related to the accounting. So first we are having the principle which is called as realization principle. The realization principle basically indicates that when revenue should be recognized, when should you be recognize the revenue in your income statement. It says that revenue should be recognized only once it has been earned, when the products or services are sold or supplied, regardless the cash payment is received or not. So basically you have to record or you have to recognize the revenue in the books of the account when it has been earned, when you have provided the products or when you have provided the services, regardless of the fact that you have received the cash payment of it or not. But once you have provided the goods and once you have delivered the services, you will record that amount of revenue in your books of accounts, and that is basically in your income statement. So for example, let us see an example of a product. For example, a company is manufacturing soap. On January 1, 2018, the company has manufactured 50 soaps of worth rupees 50,000, and on February 1, 2018, the company has made cash sales of rupees 30,000, and on March 15, 2018, the company has made credit sales of rupees 20,000. So you will record the revenue in your books of account on February 1 and on March 15, as you have made the cash sales or you have made the credit sales and you have sold that amount of soap on February 1 and March 15. So you will record that that amount in your income statement or in your books of accounts on February 1 and March 15, regardless of the fact that you received the cash payment or not. But once you have provided the product, you will have to record that revenue in your books of account. Similarly, let's say take an example of a service. A radio company aired an advertisement in the month of August, but the payment of the ad is received in the month of September. The company will recognize the revenue in August in which it has provided the services, regardless of the fact that the company has received the payment in the month of September. But once they have provided the services in the month of the August, they will recognize that revenue in the month of the August. So this is basically our realization principle, which indicates that revenue should be recognized only once it has been earned, that when you provided the products or when you delivered the services. Once you have provided the products or services are supplied or sold, regardless you receive the cash payment or not, you will have to recognize that revenue in your books of accounts.